Hello there, finance friends. So in this next set of videos, we're going to jump into income taxes. And we're going to be taking a look at income taxes from a few different angles. We've saved this set of videos for the end of our time together because one, I wanted to show how all the previous things that we've done sort of tie in. And two, I think that taxes are a nice way to capstone our time together because it helps us to see kind of the big picture from a systems lens and to put a lot of the concepts we've had up until now together. So let's jump into a discussion on the basics of income taxes. And what I want to do is I want to start at a kind of a top systems level, as we always do. And then from there, we're going to sort of get more granular until at the end of this, we'll actually do together a mock tax return. We'll make up some fake W-2s and some other forms, and I'll teach you how to go systematically through Form 1040, which is the federal tax form here in the USA, and how to take data from your different income sources, input that, calculate your taxes. We'll also take a look at some of the ways that you can legally reduce your taxes. And I think that's a good place to start because ultimately taxes are one of the opening things that we looked at in our system. So if you recall, at the very beginning of our time together, we took a look at kind of the big flow of money. And we said that you start off with gross income. And gross income is the total that you make before taxes. So bear in mind that when we have tax jargon and tax lingo, gross means before taxes. Your gross pay, your gross income is the income that you make, that you earn from all your sources before taxes. Now, from there, we have taxes taken out, which sucks. And then once your taxes are taken out, the amount that's left over, that is your net income, which is also called your disposable income, because since your taxes have been taken out, that net income, that disposable income, is what you have at your disposal to spend. And then we learned that you spend obviously on, we had our basic ideas. We said that you spend on obligations, on luxuries, and on savings and investment. And we looked at a few different ways to approach this, including a really nice, simple rule called the 50-30-20 rule, where 50% of your net income should go to your obligations, 30% to luxuries, and 20% to savings and investment. So this was pretty standard stuff, and we've gone through this almost every time that we've met together in lecture. But now that you see that we go from gross, we subtract our taxes, and that's our net. And our net income is what we actually have to spend on both future us and current us. Now, hopefully, you see why this is so important. Investment. So from a systems lens, we really, really want to take a look at the impact of these taxes on your net income and how we can reduce those taxes. And in fact, when you get right down to it, when it comes from a straight personal finance perspective, you obviously want to understand taxes and understand the jargon and the lingo, but you really have a couple of broad goals. And those goals are to either defer, reduce, or eliminate your taxes. If you can defer the taxes, you say, I'm going to make the money now and I'll pay tax on it later, thus freeing up cash flow now and letting you take advantage of the time value of money. To reduce your taxes right now, is great because if you reduce your taxes, then you have a higher net income and you can spend more on your categories. And in a perfect world, you could find a way to eliminate taxes, meaning you keep everything you make. So from a systems lens, we want to understand that taxes reduce our gross income and thus reduce the amount that we can spend on our day-to-day consumption and on our future selves. Therefore, we're going to look for ways to legally defer, reduce, and eliminate taxes, thus increasing our cash flow, reducing what we pay to the government, and keeping more for current us and future us. Okay? So that's kind of a top level thing. From a systems lens, we've also always talked about how things interrelate, and taxes are no different. Your taxes are going to have the taxes that you pay, and your ability to navigate taxes are going to have a pretty big impact on your financial life. In fact, for most Americans, their house and their tax burden are the two biggest sources of expenditure. Basically, the two biggest things that you'll spend money on are your tax burdens to the government and your home. So therefore, you want to be cognizant of the impact. What kind of impact will taxes have? Well, number one, obviously, by reducing your cash flow, taxes are going to constrain your budget. Taxes also are a form of an incentive, actually a negative incentive. You don't want to pay taxes, so higher tax rates can incentivize certain behaviors. And the ability to reduce taxes through things like tax deductions is going to be incentivized. So we're looking at an incentives lens. It's also important to understand that it's going to impact other aspects because taxes, basically, certain types of income are taxed differently. So we're going to say here that different types of income are taxed differently. So it's going to, especially as you get near retirement, thinking about retirement. We've talked about retirement in the lens of setting up your accounts and funding it and getting that time value of money. Now we add the other element, which is how much do you keep? And how can your retirement plans actually make you better off today, not just in the future? So it's going to have an impact on how you do retirement planning. We've talked about investing and we learned about capital gains. When I said up here in number 3 that different types of income are taxed differently, one of those sources of income is capital gains. Depending on how long you hold an asset, the capital gain that you pay could be at your normal tax rate or at a lower preferential rate. So the tax structure and the tax law structure is going to have a big impact on how much of what you invest and earn you actually keep. In addition, we talked about home ownership. Well, of all the different things that can benefit you as a taxpayer in terms of deductions, home ownership is one of the big ones. The federal tax code that we have here in America gives a couple of pretty important tax breaks, tax deductions to homeowners. So the taxes and the tax system is going to have an impact on your decision around home ownership. So there's a lot that's going on here. One of the big things to think about, so we've talked about, the systems lens and the impact. One of the big things to think about is that ultimately the tax code that we have, while you may think it's fair or unfair, while you may think it's simple or complicated, it is all a series of laws. It is a series of laws. The tax code is a series of laws that have been passed by the government. I guess all laws are passed by the government. Therefore, what's critical for you to understand is that the tax law represents things that the government sort of wants you to do. and therefore things that the government makes somewhat financially attractive for you to do. Okay, so we're going to take a look at the mechanics of taxes, but I don't want you to ever overlook the impact. And not just the impact on your day-to-day cash flow, while that's important, but the bigger picture that ultimately the tax code represents the government's preferences for things that they want you to do more or less of. Now, again, you can go into lots of political directions, more activist or let's say more libertarian. And it's a legitimate question to ask, like, should the government actually be doing that? Should the tax code be a source of effectively social engineering and financial engineering? But that's for a poli-sci class. Our purpose here in personal finance is to understand how these tax codes affect you. You may or may not like the game, as it were, but it is the game that we have to play. So we're going to really focus on learning the rules and learning how to play that game effectively, which again would imply deferring, reducing, or eliminating taxes to reduce this number and therefore increase this number here. Okay? One last thing before we end this video and move on. I want to just talk briefly about the taxes that you'll pay. You are going to pay, as an American citizen, a lot of taxes. Some of the more common ones, and the ones that'll be the focus of our lectures together, are the following. Number one, what we call payroll taxes. Payroll taxes are, as the name suggests, are taxes that are levied solely on your income. Okay? Payroll taxes are taxes that are levied solely on your income from your job. Payroll taxes are not assessed on things like rental income or investment income or interest income or anything else. It's a tax that's based on the amount that you earn in your wages. These payroll taxes are also called Medicare taxes, or Social Security taxes, or FICA taxes, or OASDI taxes. And this is because under our system, the payroll taxes that you pay today go to support Social Security and Medicare payments for today's retirees. So the system that we have for Social Security and Medicare is current retirees receive benefits, and those benefits are effectively kicked in by current workers. One day when I retire, if I retire and you're still working, your payroll taxes will pay a part of my Social Security benefits. And one day when you're old and gray and bitter and you're retired, the next generation's payroll taxes will pay yours. So payroll taxes are also called Medicare, Social Security, FICA, and OASDI taxes, because those are all sort of synonymous with Social Security and retirement benefits. Okay? Now, payroll taxes, you should know, compose 7.65% of your income. It's important that you know that. Payroll taxes are 7.65% of your income. We should actually say of your wage or salary income. Within that 7.65%, that's further broken up into two categories. So payroll taxes, FICA taxes, have two subcomponents. Subcomponent number one is the Social Security part of it, and subcomponent number two is the Medicare component. Social Security taxes are levied at a rate of 6.2% of your wages. However, that 6.2% only hits the first $184,500 of your wages. This is in 2026. This changes every year. But Social Security taxes, this 6.2% of your wage, has an upper limit of, in 2026, $184,500. This means that in 2026, the maximum amount of Social Security tax that you will pay is going to be equal to $11,439, which is equal to 6.2% times this upper limit of $184,500. Okay, there's that. Now, the second one is Medicare. Medicare is levied at a rate of 1.45% of your wages. Okay, so Social Security, 6.2%, Medicare, 1.45%. That's how together we get the 7.65. Okay, now here's the thing. Whereas Social Security has this upper limit above which none of your income is subject to Social Security taxes, Medicare taxes have no upper limit. So if you make $3 million in salary, only $184,500 of that is going to be hit at the 6.2% rate for Social Security. But all of it is going to be hit at the 1.45% because, again, Medicare has no upper limit. And in addition, Medicare has a little extra for high income earners. So if you're a high income earner, which means under current tax law that your taxable income, that your income is greater than $200,000, in addition to your base 1.45%, you're also going to pay what is known as the additional Medicare tax, which is equal to 0.9% of your wages over $200,000. Okay, so you can see already this will be kind of confusing. If you earn $100,000, you're going to pay 6.2% on that 100 and 1.45%. Sorry, if you make $100,000, you're going to pay 6.2% of that 100,000 for SS, 1.45% for Medicare. If you make, let's say, $190,000, you're only going to pay 6.2% on 184,500. You'll pay 1.45% on the full salary. If you make, let's say, 300,000, you'll only pay 6.2% on 184,500. You'll pay 1.45% on the full 300,000, and you'll pay 0.9% on the 100,000 that exceeds that threshold. Okay, so there's already a lot going on. Don't be afraid of it. You'll get fluent with it, but just be aware that the first tax that you have to pay that comes right out of your paycheck is your payroll taxes, 7.65 total. In addition to that, you also pay federal income tax. When most people talk about taxes, this is what they're talking about. These are your federal income taxes. These are the ones that you report on your Form 1040, which you file every year. The important difference is, number one, payroll taxes are only on your wages. Income taxes are assessed on all income. Wages and salaries and capital gains and pensions and Social Security payments sometimes, and interest income and dividend income and lots of other income. Okay? So that's the first difference. The second difference is these are taken right out of your paycheck, basically automatically by your employer. You are going to have federal taxes withheld by your employer. And if you have a job, you know that when you get your pay stub, they always have the gross amount that you earned and then withholdings that your boss took out. Your boss takes money out of your paycheck and submits it on your behalf to the federal government. That tax is automatically withheld. Later, you do your tax form, and your tax form reconciles the amount that you had withheld from the amount that you actually should have paid. Okay, that's confusing, but we'll have a separate video for that. But just for now, know that your federal income taxes are on all income, and you're going to file a tax return to get that right. And then the third tax that you're going to pay, for most Americans at least, are state income taxes. There are a handful of states that don't have state income taxes, but most do. In California, this is filed on your Form 540. So typically, your state income tax effectively mimics your federal taxes. And usually, like not usually, always, when I do tax work for my clients, I always do their federal return first because that's the biggie. And then the state income tax just sort of flows from that, usually mimicking the federal taxes with a few different state-by-state adjustments. Okay? So anyway, that's what I wanted to say in this opening video. You're going to pay a lot of your money, a lot of your income in taxes. You're going to pay 7.65% off the top for your FICA. And then you're going to also pay some federal income tax and some state income tax. By the end of it, by the end of those three taxes, it is not uncommon for anywhere from a quarter to a third, in some cases, even 40% of your income being taxed. Think about what that means. Think about what that means. If between your FICA, your federal, and your state income taxes, between those big three, let's say a third of your income is taxed, that means that 1/3 goes here. And only 67% of what you actually labored for do you get to use for yourself. For clients of mine who are higher earners and are effectively paying 40% taxes, think about what that means. 40% taxes mean that you work on Monday and Tuesday. If you have a 5-day week, let's say, if you have a 5-day work week and you pay 40% of your income in taxes, that means that you work on Monday and Tuesday for the government. And only on Wednesday do you begin working for you. So this is clearly a big burden. And as we said before, it's going to act as a budget constraint. There's going to be some incentives involved. And that's what we're going to spend the rest of our time looking at, okay? So this is our opening. In our next video, I'm going to go at a very top level through the federal income tax, and I'm going to stress a really big, important idea, the idea of marginal tax rates. When we talk about taxes, we talk about marginal taxes and marginal tax rates. This is a critical thing you have to understand. So in our next video, at a really kind of top level view, we're going to look at the federal tax system, the federal 1040, and we're going to look at marginal tax rates, okay? Thanks for tuning in, and I will see you in the next video. Take care, friends.